Okay, Nephili, it's time to talk about bonds.
Bonds can be confusing to people, Danai, so let's try to explain in a simple way.
Yes, they can actually be quite confusing. Bonds are used when you are lending money to a company or the government. They promise that they will pay you back all your money within a certain period, plus an interest. So it's the opposite of when you get a loan from a bank. Here you are the one lending money to somebody else. This is usually called a fixed income instrument and a fixed income investment. This is because your return is a fixed amount, which is the interest you earn and is predetermined.
That's great, Danai. And there are two main types of bonds: government bonds and corporate bonds. There are some others, but we will keep it simple. Corporate is another name for company, just to be clear. Government bonds may have different names in different countries, but they are essentially the same thing. In the US, they are called treasuries, and in the UK, they are called gilts. You will also see some other names for US treasuries, which distinguish the maturity range like bills and notes. Let's give an example. Let's say the US government wants to borrow $50 million because it needs to build more roads. It doesn't have enough money from taxes and other income, so they have to borrow. This is a very common thing for many governments, but it's a bigger topic in economics that can be explained in another video. The main terms of the bond they issue are par value, $100. A bond will always clearly state its par value, also called face value. This is equal to the principal amount that the government will repay you at the end of the bond term or maturity date. It's usually an easy number to remember, like $100 or $1,000. So a number of these will be issued so they can reach the $50 million they want to raise. A person can buy only one or thousands. Coupon rate 4%. This is the interest rate that will be paid by the government to you on an annual basis. So for one bond of $100, you will receive $4 per year. If you buy $2,000 worth of bonds, you will receive $2,000 times 4%, so $80 per year. Coupon payment. This refers to the regular interest payment on the bond. So in our example, it is the $4 per year you receive per bond. It is important to note that if the bond pays interest on a quarterly or a semi-annual basis, then this $4 will be divided by 4 or 2 respectively to convert the annual rate to what needs to be paid. So let's say that this bond pays on a semi-annual basis, then you will receive $2 every 6 months. This provides you with a regular income stream. Maturity date, 10 years. The maturity date is the expiration date of the bond and when the principal must be paid back in full. So this defines the term for the bond. In our example, this is 10 years, so you will keep getting those semi-annual payments for 10 years. At the end of the 10th year, you will get back your $100 principal. So as we can see, this investment is quite different from a stock. A stock will be more volatile and will react to various macroeconomic, geopolitical, or industry-specific events, but with the ambition that its value will appreciate over time. It's a growth ambition. A bond is a less volatile, income-based ambition and a place where you aim to preserve your original investment amount. Let's be careful though. Bonds are traded just like stocks on the stock market, so you can buy and sell then any day. It's important to understand the following concept in bonds. The price goes up or down based on various events, and there is an inverse relationship between the price and the return we receive, which is called the yield. If the price of the bond rises, the yield falls, and vice versa. Let's say that we do buy the bond in our previous example, but we do it 2 years after it was issued, and the market price of the bond is $97, not $100. How much interest will we receive? The coupon payment is still the same. We will still get $4 per year. But as you can see, this is like getting 4.12% interest instead of the 4% if the bond price was $100. Why? Because we bought it cheaper. As we saw before, when the market price is lower than the par value, the yield is higher. If the market price is higher, the yield is lower. Plus, at the end of the 10-year period, we would still get the full $100 principal value, even if we paid $97 for it. Why? Because the issuer, the government in this case, doesn't care what the market price is. They have to honor the bond paper they issued. There is another important term that we can talk about, yield to maturity, but we will leave that in our monitor module as it can be more technical. One of the largest factors for changes in bond prices and yields are interest rates. If interest rates go up, bond prices go down. If interest rates go down, bond prices go up. This is important to know as interest rates are such a key economic parameter that affects a lot of things in our finances.
Very clear example, Nephili. Now let's talk a little bit more about the two types of bonds and how they differ. Government bonds, as we said, are issued by various governments, so they are backed by them. This means that the risk of them not paying you the interest and repaying your principal is the country defaulting, or in simple street terms, going bankrupt. You can imagine that for developed countries like the US or the UK or Germany, defaulting on their sovereign debt, as is called, is a very rare event. It actually never happened during the modern times. There are ratings that give a score to these bonds, and one can see their creditworthiness like AAA or AA+, and so on. Let's turn to corporate bonds. They are very similar in the mechanics, but they differ quite a lot in their risk profile. First of all, why would any company issue bonds? Well, it's part of the financing plan of any company. Depending on the business, it needs money to be able to invest in machinery, computers, people, advertising, expanding in other regions and countries, and so on. It can either get money from the initial owners, raise stock in the stock market as we saw before, or borrow money. It's not an easy task, and companies need to prepare a detailed business plan, analyzing all these options carefully. So as we can see, the two cases have different risks and, of course, different potential yields.
I really love this challenge businesses have, and I hope one day I can learn about it more during my university life. So if they decide to borrow Danai, they have two main options. Either go to a bank or go to the markets. Going to the markets means to issue a bond in a stock exchange so that the public, people like us, but also other big institutions can buy. This is a very big chapter that we will not go into, but it's sufficient to say that not just any company can issue public bonds. You need to satisfy certain criteria, and that's the point we want to make here. One has to be careful which company issues a bond and what is the credit rating of the bond. That's called their creditworthiness. They range from very solid companies which they are rated investment grade to the non-investment grade ones, so their bonds are called junk bonds. The more solid the company is, the less coupon rate they are typically willing to give. The higher risk a company has, the higher coupon rate is typically given in order to attract funds.
We will talk about choosing the various bond characteristics in our capital allocation module, including coupon rates, maturity dates, etc. We will also talk about what % of bonds and % of stocks should one have in a balanced portfolio. We hope this was helpful. Thank you for watching, everyone.